Welcome to another deep dive. Whether you are, evaluating a company, maybe building a team, or just intensely curious about how money actually works behind the scenes, we've got a massive mystery to solve today for you.
We really do. It's one of those things that seems straightforward, but absolutely isn't.
Right, because what separates a business worth, say, 3 times its profit from one worth 8, 10, or even 12 times, you'd think the math is just the math.
Yeah, you would think that. But it's not.
Exactly. So today we're uncovering the secret math of business valuation, specifically looking at the restoration industry. And this is all based on some really eye-opening insights from the Insurance Intelligence podcast featuring Jeff Magoon.
It's a great source, yeah. Really pulls back the curtain.
It does. Okay, let's unpack this. Our baseline here, setting the scene, and by the way, the backdrop you've got going on today, this sleek, modern cityscape with those translucent financial charts hovering over it, is totally working for this.
Oh, thanks. Yeah, I figured it'd fit the whole corporate valuation vibe we're going for.
It totally does. But to set that baseline, the source material makes it super clear that today's buyers, so private equity firms, strategic acquirers, family offices, they are looking far beyond just revenue and profitability.
Oh, way beyond. I mean, they're looking at how the entire business is actually built from the ground up.
Right. Which leads us to the most common mistake business owners make, which is equating high revenue with high value.
Yeah, the revenue illusion. It's a trap so many people fall into.
So explain that. What is enterprise value then if it's not just the money coming in?
Well, enterprise value it's not about what you made last year. Buyers don't care about the past, really. They care about a company's ability to generate sustainable future earnings.
Sustainable being the key word there.
Exactly. Sustainable and predictable while minimizing risk. So the sources give this really stark comparison that makes it easy to understand. Imagine two restoration companies, right?
Okay, company A and company B.
Right, and both are generating exactly $15 million in revenue.
Identical on paper.
Totally identical. But let's look at company A first. In company A, the owner makes literally every single decision.
Oh, a micromanager.
Yeah, or just someone who never built a team.
Mm-hmm.
And sales, they totally depend on the owner's personal relationships. There are, no documented procedures at all.
Yikes. So people are just winging it.
Pretty much. And because of that, you see high employee turnover, a really poor safety record, and, frequent insurance claims.
That sounds incredibly stressful.
It is. Now, flip over to company B. Still doing that exact same $15 million, but they have a real leadership team in place.
Okay, so the owner isn't running around putting out every fire.
Exactly. They have standard operating procedures or SOPs for everything. There's a strong culture. Their customer base is actually diversified.
Nice.
And they use modern technology. They have reliable financial reporting. It's a tight ship.
So even though the revenues are completely identical, company B commands a dramatically higher valuation, right?
Oh, massively higher.
Yeah.
Because buyers buy predictable businesses, not owner-dependent ones.
I mean, that makes sense. The analogy that jumps to mind for company A is, it's this high-performance sports car.
Okay, I like where this is going.
It goes incredibly fast, it looks amazing, but there is literally only one specific mechanic in the entire world who knows how to start the engine.
Yes, that is exactly what it's like.
Sure, it goes fast today, but what happens if that mechanic gets sick? Or wants to retire?
The car is just a very expensive paperweight.
Right. But wait, I have to push back a little here.
Sure, go for it.
Because if I'm an owner, isn't $15 million still $15 million? Doesn't the fact that I hit that revenue naturally prove the business model works? I mean, the money is in the bank.
Well, it proves the owner works hard.
Yeah.
But it doesn't prove the business model works for a new owner.
Oh, I see.
Yeah, revenue with high volatility and dependency, it's a liability, not an asset. If a buyer writes a check and that owner leaves, that revenue could just vanish.
Because the relationships leave with the owner.
Exactly. And the knowledge leaves with them too. So a buyer is going to discount that heavily.
Okay, so if revenue is just the shiny exterior, how do buyers actually find out the engine is broken? Because an owner isn't going to just volunteer that information.
No, they definitely won't. And that brings us to the due diligence process, which is basically putting the business under a microscope.
So if we're popping the hood, what are these hidden liabilities they're searching for? The things that reduce confidence and lower the valuation.
The text categorizes them really clearly. First, you've got financial issues.
Like bad bookkeeping.
Yeah, weak reporting, cash flow instability, and a big one customer concentration.
Right. If one client makes up 50% of your revenue, that's terrifying for a buyer.
Exactly. If that client leaves, half the business is gone. Then you have operational issues.
Which would be what, like bad management?
Weak management, no succession planning. A really specific one for restoration is inconsistent estimating.
Oh, if two project managers quote the same job totally differently.
Right? It means your margins are completely unpredictable. And then there's poor documentation.
So what does this all mean for the business owner? Are buyers basically like ruthless home inspectors tapping the walls looking for black mold so they can lower the asking price?
That's a really good way to put it, actually.
But how do you proactively prove a negative? How do you prove to a skeptical buyer that you don't have black mold in the walls?
Well, if we connect this to the bigger picture, every single unanswered question a buyer has reduces their confidence.
And reduced confidence mathematically lowers the value.
Exactly. So you prove the absence of risk through extreme standardization. You document everything.
Okay, but anyone can write a manual and stick it on a shelf. How do they know you actually follow it?
That's the secret.
Mm.
And it's one of the most surprising insights from the source material.
We're talking about insurance, right?
Yes, insurance. In the restoration industry, it is no longer just about protection.
Here's where it gets really interesting. Because most people, you and me included probably, think of insurance as a grudge purchase.
Oh, absolutely. A totally necessary evil.
Just a box you check.
Dang
So
it.
are you saying private equity firms are actually sitting around reading insurance policies for fun during due diligence?
They really are. But they aren't reading them for fun. They're using them as a diagnostic tool.
How does that work?
Well, sophisticated buyers don't just ask, how much is the premium? Anyone can see the cost on a spreadsheet.
Right.
They ask, why is the premium what it is?
Because the premium is based on actuaries and real data.
Exactly. A clean loss history and an excellent claims record tell a story. If your premiums are super low, it means you don't have claims.
Which means your people aren't getting hurt.
Right, which means you have better safety practices, which indicates better hiring, better training, and better leadership.
Oh, wow. So your insurance policy is basically a verified third-party report card on how well you run your business.
That is exactly what it is. It proves you aren't just faking those manuals on the shelf.
That is wild. I never thought about insurance that way. But okay, if a clean insurance record is the proof of a well-run business, how does a company actually build that machine on a day-to-day basis?
Yeah, how do we move from diagnosis to actually implementing this stuff?
Right. The text outlines some specific traits of high-performing restoration businesses, doesn't it?
It does, and a huge one is technology integration, specifically artificial intelligence.
AI is everywhere now.
It is, but here it's changing valuation directly. Modern businesses are using CRMs, job management software, and automated reporting.
Right.
But using AI for things like scheduling, estimating, marketing, and knowledge management, that creates what buyers call operational leverage.
Operational leverage, meaning higher profitability without actually increasing headcount.
Yes, you can take on 30% more jobs without having to hire 3 more admin assistants to handle the paperwork.
The AI just absorbs the extra workload.
Exactly, which means all that extra revenue drops straight to your bottom line,
And increases the EBITDA.
which then gets multiplied by the buyer. It's huge. But technology is just one piece. The sources also talk about culture.
Right. And it's not just about hiring good people.
No, it's about clear missions, shared values, and real career paths. Because culture reduces turnover,
And lower turnover increases consistency.
and consistency increases value. Exactly. And the final piece is relationships.
So having trusted networks with carriers, adjusters, property manager.
Right, and even technology partners.
Yeah.
Those become tangible competitive advantages.
Okay, I have to challenge this, though. The pairing of AI and culture.
Okay, let's hear it.
We have AI on one hand, right, doing automated reporting, eliminating headcount needs, making everything super efficient.
Right.
And then on the other hand, we have culture, which sounds very human and a bit squishy to a private equity spreadsheet.
I get what you're saying.
So which one actually moves the needle more for a buyer? Aren't they kind of at odds?
What's fascinating here is that they aren't at odds at all. They're actually two sides of the same exact coin. Well, AI handles all the predictable, repetitive tasks to create that operational leverage we talked about.
The busy work.
Right. But culture retains the humans.
Yeah.
And you need the humans for the complex relationships that actually drive the restoration business.
Oh, because when a building floods at 2 in the morning, a property manager doesn't want to talk to an AI bot.
Exactly. They want to call the specific project manager they trust. If your culture is bad, That project manager leaves and takes the relationship with them.
That makes perfect sense. You automate the routine so the humans can focus on the relationships.
You got it.
So knowing what needs to be done is one thing, but who is doing this and when should a company start? This brings us to the core philosophy of the Magoon Group from the source material.
Right. The Magoon Group's approach is really interesting because they argue that insurance is just one component of enterprise value.
It's just the diagnostic tool.
Yeah, real growth requires a totally holistic strategy. You need operational consulting, brand positioning, leadership development.
So the goal isn't just renewing your insurance policies cheaply.
No, the goal is building a resilient, profitable company over time.
Over time. Let's talk about that timeline, because if you're an owner listening to this, you might be thinking, look, I just want to fix properties. I didn't start this to become a corporate spreadsheet.
That is a very common sentiment in this industry.
So if someone is planning to sell in exactly, say, 5 years, is it too late to start doing this tomorrow?
The text is super firm on this. Whether you plan to sell in 2 years or 20, the work starts today.
Why today?
Because enterprise value is built intentionally, one decision at a time, every single day you operate.
You can't just slap SOPs together a month before you sell.
Exactly. Every process you document today, every risk you eliminate tomorrow, it adds mathematical value immediately.
Well, this has been an incredibly eye-opening discussion.
It really changes how you look at a business, doesn't
It
it?
totally does. To summarize the core aha moments for you listening, revenue absolutely does not equal value.
Not even close.
Insurance is literally a report card for your operational health. And buyers pay massive premiums for predictability and scalable systems.
That's the formula right there.
It is. But I want to leave you with a lingering, provocative question to mull over, something that builds on everything we've talked about today.
Oh, I like a good closing thought.
Right. So the whole goal of building enterprise value seems to be completely removing the owner from the equation to create this perfectly predictable machine.
Yes.
But the source explicitly described restoration as a deeply relationship-based business.
It is. Very human.
So here's something for you to chew on. If you perfectly systemize your business, integrate AI everywhere, and make yourself entirely obsolete, do you risk stripping away the very human essence that built those foundational relationships in the first place?
That's a tough balance to strike.
It really is. How do you scale a handshake?
Wow. Good question.
Thank you so much for joining us on this deep dive. Keep questioning the world around you, and we'll see you next time.